I'm Keith McCullough, and welcome to another Real Conversation. This one's going to be fun. For a long time, as a younger buck, I guess, when I came onto the buy side, I've always had David Rosenberg as one of my favorite economists. In the beginning, people said it was because I was biased because he's Canadian, and then over the years, of course, I've followed him very closely, and now I got the gray hair too. So welcome, David, and thanks for making some time.
No, it's great to be on, Keith. Thanks very much.
Some people think you and I are going to get in a fight about inflation. I think we're going to fight about you being a Habs fan. I thought you were a Leafs fan, man.
No, when I was a young buck, lying down watching the game on black and white on the parquet floor in my house in Ottawa, I was 5 years old, and I said to my dad, "Who's number 4?" And he said, "Jean Beliveau." And I said, "Who's he play for?" And my dad said, "The Montreal Canadiens." I said, "Okay, I'm in."
Nice.
That's all she wrote.
Well, it was a good night for Carey Price and of course your Habs last night. So congrats on that.
Yeah, we're soundly beaten in every single aspect except the score, but.
That's good. Well, we do stand on different sides of the inflation debate, and I want to actually just get into kind of not the plumbing, but the specific differences, if there are many. I've been bullish or long inflation for a year now, so it's not like I just went bullish because people started talking about inflation. And I am quite interested in understanding the path and the differences of the disinflation, because of course we're going to see the peak of the cyclical inflation that I've been longing for. Yeah, we're going to see that imminently, really, from a modeling perspective. But I want to get your thoughts first on the trajectory of what you think is going to go away, and however you want to define it in terms of inflation outright going away or just disinflating at a slow pace, whatever you think.
No, well, look, I think what we've got on our hands is a deviation from a trend line. And look, you and I would be having the same conversation a decade ago when we came out of the recession, the Great Recession. The economy for a time period was strengthening. We had Obama's infrastructure package. We had fiscal stimulus. We had quantitative easing upon quantitative easing, zero rates. Remember back then, Bernanke was being used as the piñata by the inflationists, much like Powell is right now. And inflation actually, for about a 16-month period, went from 1% to 4% in 2010 into 2011. And the reality is that nobody remembers that because nobody remembers that. And so people might remember what's happening right now because in the context of the pandemic. But it's a deviation among a trend line. I would say among the inflationists, you have to explain to me what's really changed, except for the fact that we're living in a world where the data has got extreme dislocation and distortion and noise because everything that's happened in the past 16 months. I just don't know. And I'm willing to admit if I'm going to be wrong. I just never have seen so many people on one side of the trade talking about inflation that we're just so certain that the first global pandemic in over a century was going to be the trigger point to achieving inflation. That no other central bank or fiscal authority was managed to do in the past 2 decades. So I still think the onus is on the inflationists to see if they're going to be right. When you're asking me, what I'm looking at the fundamental trend line and understanding that we do have a gyration around that we can talk about the disturbance or the dislocation now between aggregate demand and aggregate supply. And we do have a dislocation right now, and it's lasting several months. I don't, Jay Powell never really defined what transitory is, but transitory could even be a year, or it could even be a year and a half. And we had that actually. I wrote in my breakfast with Dave recently, all these 12 to 18-month periods where you get inflation spasms, but they're not sustained. And the reason they're not sustained is because of what I call the 3Ds. What's defining the trend line is debt, and then we're more excessively in debt than we were before, and the debt that we have in our hands right now globally, and in the U.S. and in Canada is deflationary. We are still in a debt trap, and it's a constraint on demand and it's a constraint on inflation. So we have debt, that's 1D, and we have disruptive technology and the fact that productivity is accelerating, and we have the aging demographics, the other D, which is people like to claim that. And Jay Powell talked yesterday about how there's a part of the depleted labor story is people retired earlier than they normally would have because of the pandemic. I wish I was one of the media that could have interviewed him yesterday because there's not just a supply effect from demographics, there's a demand impact. And the fastest growing share of the US economy is the share 65 years and older. And that share of the population, by the way, is going to continue to go up right up until 2030. And why 65 years and up is so important is because it's the only age cohort where spending on average goes down 30% from the age cohort in the previous 10 years. The life cycle is such in the demographics that it's deeply, deeply disinflationary. So right now, look, over a year ago, the initial impact of the pandemic was to hit demand relative to supply. So we had several months where the PPI and CPI readings were negative. We actually had a month, if I'm not mistaken, where the front month contract and WTI went negative. Commodity prices were in free fall. And now we've swung the pendulum the other way, where we've got the vaccinations earlier than expected. We've got the reopening trade. And so with all that, the demand, and of course, with all the fiscal stimulus, has come back much faster than supply. Well, the demand's come back faster than supply, and that's created a short-term inflationary process. But that's what we've got on our hands. I think it's disingenuous, and I'm being polite when I say that, to assume that with the reopenings, there will only be an impact on demand, but no impact on supply. There's no evidence that that's going to be the case. And in fact, once the supply starts to catch up, demand growth is going to be fading away because the fiscal stimulus is yesterday's story. So I actually think that starting September, October, people will be surprised at how weak the CPI and the PCE prints are going to be. So the inflation we have right now, and it is real, at the same time, I don't see the grounds that it's going to be sustainable.
Yeah, that's, and I want to get into the specific timing of that. It's interesting because the 3D risk, I used to write that all the time. I think you were at Gluskin, I was still here. But those things, those things aren't going away. They haven't gone away. And sometimes I'm on the deflationary side of the trade. Sometimes I'm on the inflationary side of the trade because it's just cyclical. It goes up and down within a long-term downtrend within inflation. So I absolutely agree with the long-term on that. The timing from a market perspective, however, like I can get crushed if I get out of deflation too early. 2016 is a good example. Or if I get off the inflation train too early. And I'm talking about like real, full cycle investing returns, as I like to call them. But again, no debate on that. Maybe we can kind of touch on the demographic differential between this millennial generation coming into their early 30s, like their household formation years, later in the conversation. But first, I want to just show the slide of our nowcast, because this has surprised me, David. I don't tell the data what to do. I don't tell the commodity market what to do. I just, again, it's a predictive tracking algo. I go with what the data's printing in our nowcast, and it's been accurate over the years, and it does capture both the declines and the ascents because it does respect those base effects. You're absolutely right. I mean, when you had a negative oil price, obviously you can. I don't know if you can see this, but you'd know this by heart. You're one of the great economists of our time who knows every number. But again, the number went to zero because the oil price went negative. So now the number is closer to 5 because we're comparing against that. What has surprised me, and I want to get a little bit more specific about this, is how my nowcast in the out quarters, particularly this coming quarter, would be what I would call trending inflation for multiple quarters here, as opposed to just a one-off quarter. And I think you did say that this could be a year or year and a half. It's also interesting. Steve Hanke said the same thing, using his velocity of money model, which maybe we can talk about that too. But really, I use my model. I want to know like how those numbers are going to come down in the coming quarters, especially with a couple of the big components of that model, still almost guaranteed to go up.
Well, I think that for the next several months, the numbers could still be pretty hot. But so the question I ask is, so what? the we are still in a global pandemic. It's nice that Dodger Stadium is filled and the New York restaurants are filled and things appear to be back to normal. Nothing is really back to normal, and the world is not back to normal. We are still in the midst of a global pandemic, and it's been a roller coaster ride. And we had the initial health shock, then the lockdowns. We had recurring waves, massive fiscal and monetary stimulus, then the vaccinations, which were a game changer. And then we had a relapse in the economy towards the end of last year, then two massive rounds of fiscal stimulus. You think things are really that strong? I know that Jay Powell had his particular view yesterday. Without all the fiscal stimulus, the economy is so weak that the level of GDP right now would be 6% lower than it is today with all that fiscal intervention. The primary sources of vitality in the economy, vaccinations, and stimulus checks. So, we have a situation where, because of the pandemic, it's created supply blockages. The fiscal stimulus and the fact that people for a long period of time weren't allowed or couldn't or wouldn't spend money on travel and tourism and recreational services. So we had an unprecedented boom in consumer spending on durable goods, and the supply side's been curtailed and slow to come back. So we've got this inflation related to supply chain bottlenecks. And then, of course, we have the fact that the airlines and tourism and hotel accommodation, casinos, restaurants, they're all coming back. A lot of these areas of the consumer cyclical services, their price level is actually still below where it was pre-pandemic. They're just filling a gap. So I would just submit to you, you can talk about the data and that's fine. You can throw up your bar charts, but at some point you do have to explain what's going on. And what's going on is actually very explainable. And so it's just the dislocation caused by the pandemic. It's the reality that when you look at the major incoming economic data, whether it's nominal or real variables, in the past 16 months are 6 times more volatile than they've been in any other recession or expansion. The data are 6 times more volatile. And at the same time, when you're taking a look at the consensus, which are normally not very good at calling the data in any event, more than twice as bad as normal. So we're in this period of really elevated uncertainty, and we do have a tremendous bottleneck right now in parts of the goods producing sector at the same time that pricing power, and it's not real inflation, they're just filling the deflationary gap from last year. So it's creating these short-term disturbances. And so I consider myself to be an analyst. I analyze the data. I don't report the data. I report. I analyze. And I respect equity strategists who take the time to measure breadth in the stock market, because if you have a stock market that's being fueled by 2 or 3 stocks, it's not a very healthy market, even though the headline indices are going to new highs. Every technical analyst knows that. What I don't quite understand is how come people in my community, economists, don't apply the same discipline and looking at the breadth of the data. So I'm looking at the CPI data, for example, and I'm noticing that the inflation that you're talking about is concentrated in 20% of the index. It's concentrated in car rentals and auto leases and used cars, airlines, accommodation. So anything that's related to the pandemic. And all the impacts, direct and indirect, from the pandemic. That 20% of the index in the past 6 months, for example, the prices have exploded at a 22% annual rate. But there's the other 80% of the economy that has not been affected by the noise from the pandemic or the responses and the indirect and direct impacts from the pandemic. And that 80% in the past 6 months is running at a 1.6% annual rate. And I look at that 80% because that is the non-noisy segment of the pricing structure. That is the stuff that has not been impaired from the pandemic and all the distortions around it. That's the underlying trend. People want to say to me, why is the long bond, why isn't it already not at 3%? Why is the 10-year not over 2%? Because there's sophisticated people out there that recognize the story beneath the headline of these price numbers. It's heavily concentrated. I did the work because I want to do my own work, but I could have just said, hey, the Cleveland Fed median CPI, is that going up? No. Why? It's running at 2.1%. It hasn't actually been accelerating. Before the pandemic, the median CPI was running at 2.8. So it's a very narrowly confined story. It will come out of the wash. So the answer to the question is I'm not hyperventilating. I wasn't telling anybody over a year ago, yes, please extrapolate this deflation into the future. That's a wise thing to do. I never told anybody to do that. And now everybody, it's sport. It's blood sport to talk about the Fed being behind the curve, that we're going to have massive inflation. People look at the money supply numbers. I'm telling you, for decades, the money supply numbers have had no correlation with anything to do with the economy. Maybe with financial assets, but not with the real economy and not with inflation. So people want to talk about money supply. You talked about velocity of money. Absolutely. Why is bank credit contracting? What is it about the U.S. economy that we're in credit contraction? What is it about the U.S. economy that we have the first quarter Fed flow of funds numbers where the household debt income ratio went from 96% to 85%, the lowest it's been since 1994. And you have people out there saying, oh, look at that. Look at how strong the U.S. household balance sheet is. Yeah, but here's the thing is that if you're bullish on aggregate demand and you want inflation to go up, you don't want debt to income to go down. You want it to go up. Households have been deleveraging now for years, and that's an ongoing process. One of the reasons why it was one of the weakest economic cycles of all time, despite all the gargantuan stimulus from 2009 to 2019. So people are just taking their eye off the fundamentals of frugality in the consumer sector. Why do you think Biden felt he had to go big with 1.9 trillion? Because his economists were telling him that the New York Fed study had showed that the MPC, the spending propensity from the fiscal stimulus checks, is less than 25%. 75% of it's going either to debt pay down or savings, and I guess savings is code for a Reddit or Robinhood account. So yeah, we have inflation disturbances right now, and there's no reason for me to think that it's going to be sustainable. The long end of the bond market is actually telling you it's not going to be sustainable, because someone would have to explain to me, why is the long bond rallying? And what do you know? All of a sudden, the speculators are taking profits in the COMEX and in the other exchanges, because 90% of this commodity inflation off the lows was not about real demand. It was about financial demand. And now they're taking their money and running, and copper and corn and crude are just rolling over big time right now. So when you're asking about what the inflation numbers will look like by the fourth quarter, they're going to be coming down a lot.
That's an interesting view. I'm definitely an analyst. I got 40 analysts that support me. And if you look at all the, if you look at the slide 16, so what I do is I measure and map every single time series, and I do analyze every single one, and I don't tell myself a story that isn't true. I mean, what I do think, and just to take your point on the 20% of the numbers that have gone up a lot, like just take a third of the number, which is shelter, which is going to go up a lot. So that's one point there. And the second point is, because as you know, shelter, if you're just analyzing the CPI numbers, which is going to be reported inflation. This is analyzing right down to the screws, every single data series across all of economic history. So that's what we do. That's one question. So shelter, why? Unless it's different this time, as you know, HPI, home price inflation, which is running double digits now, is the leading indicator for HPI to go up on a lag, and it goes up big time. And that's what I mean by the fourth quarter. That, never mind the fourth quarter, but the first quarter of next year, a third of the number, which is just one thing, is going to be that thing. So what do you think about that?
Yeah, I mean, I hear about the rental inflation all the time. I don't know where that comes from. I never found there to be much of a correlation between home prices. If anything, what's happening right now, from my vantage point, and you see it in the housing start data, is you're seeing the strength is coming out of the home building index, and you can see the home building index in the stock market's down 15% from the peak. You're seeing more rental construction. the vacancy rate is going to stabilize or go up. I'm not big, frankly. I know people want to build up the horror story on inflation. I get it. It's an interesting story. It's a very crowded story. I don't get on my work, and you can talk about your work. My work does not show we're going to be getting big rental inflation. I know. I mean, I debated Peter Bookvar recently. That's a big part of his thing. He's looking at other surveys. But no, I'm not getting a sense there's going to be an impulse in the rents. And in fact, coming back to what you were talking about before, if you are big on inflation and you think rates are going to back up, you think, and everybody's saying, including Peter and everybody else, rates have to back up. Mohammed Al-Arian, Fed's behind the curve. And you brought up housing. Yes, you know that when you look at house price to rent, house price to income, you look at residential real estate on household balance sheets to total assets, we are almost back to where we were in 06 and 07. We have a massive, and by the way, it's a global, but we're back into an enormous asset bubble in residential real estate. Well, you know what? Be careful what you wish for, because the last time we had commodity-led inflation that led to higher interest rates was back in that period in 06 and 07, and it triggered the collapse in home prices. And then we had a deflationary experience on our hands. We are in such an unstable equilibrium right now in the most important aspect of household balance sheets, which is residential real estate. I'm actually, in fact, if you ask me why are you a deflationist, it's because I adhere to Bob Farrell's first market rule to remember that markets tend to return to the mean over time. Now, not levels, but ratios. And these ratios in housing, home price to rent, home price to income. Now, maybe you'll say to me that the home price to rent is going to normalize because rents are going up. I don't think so. And I think that actually, if rates do back up and if the Fed pulls a policy mistake because they mistake the inflation, or if the Fed, look, Powell seemed very like a happy guy, at the press conference that but look, go ahead. We have, you're talking about inflation. It's unbelievable. We have an $80 trillion national debt at household, corporate, and government level. We have never been this exposed to interest rates in the past. And we saw in the last cycle. Like, I think that's the thing I got to say to people. It's like, so tell me exactly, the last cycle, we got to 3.5% unemployment by the beginning of 2020, 3% wage growth, 2% inflation. The Fed couldn't even hold the funds rate at 2.5%. And they're expanding their balance sheet in 2019. They wanted to normalize interest rates. Remember the big thing about Jay Powell in January 2018, when he was going through his confirmation hearings, where you got to normalize interest rates. He said it over and over again at his confirmation hearing and thereafter, and he did in fact raise rates 4 times that year and threatened to do more. The Fed believed that neutral was over 3%. Oops. And they wanted to normalize interest rates. You explain to me how the Fed could not normalize interest rates in that last cycle. And it's because you can't normalize rates in an abnormal economy. And meanwhile, we're older. Yes, I understand about the millennials and the Gen Xers, and they're all 38% of them living at home with ma and pa because they don't really have much in the way of job prospects. You cannot compare that to the advent of the baby boomers and the proliferation of female participation rates in decades past. The demographics are definitely disinflationary. And it was as true in the last decade as it's going to be in the coming decade. But it's the debt dynamics. It's the debt dynamics that matter the most. We are choking on too much debt. And that's why interest rates can't go up. And if inflation is really the big story, why is it not a global story? Explain to me why inflation isn't ripping in Japan. Why isn't the country that's actually got the strongest GDP and the first country to come out of the crisis, of course, the country that started it, first country to come out of it, China's not. Where's China's inflation on the consumer side? Now, they got producer inflation because that's all commodities. Mm-hmm. Where's their inflation? Is the U.S. just somehow become this sclerotic European type of inelastic economy where inflation is going to become a systemic problem? I mean, give me a break.
I hear you, man. I mean, but the problem with all that is that you miss a lot of market moves. I mean, the fact of the matter is that, being an inflationista is definitely not my career. As you know, I absolutely nailed the last time bond yields peaked. And this one, I just said bond yields were going to double, and they did. So we're still at the point where Like, I don't think picking today's move in oil, which is literally the first down day, is the data point. I think that it's important to have a good, healthy debate about, if you really know this really, really well, like anything, I say this to my analysts all the time, analysts, independent research analysts. If you're really good at it, you don't miss the big moves on the other side of the move. Like,
so let's talk.
There's a huge move here, David, that just happened, right? And I'm trying to risk manage my way out of it. I think a lot of the longer term demand issues to me could easily equate to this thing called quad 3 stagflation. So when I look at where inflation is likely to stick, empirically, that's what you said too. You said, look, you look at all the components. I asked you about a third of the component, which is shelter, which is absolutely going to stick. It's a back-tested reality with a 90% backtest, HPI against shelter on a lag. As you know, labor goes up on a lag too. These are all economic facts. That's that you could end up in an economic stagflation situation, which takes the S&P multiple to 7 times earnings, and a lot of shit hits the fan. Like I'm trying to get to that place. I'm not an inflationista or a deflationista. I just my job is to get, for a year, I prefer to be right. I don't want to get that wrong. We didn't make the call on bond yields breaking out until November, which I think was pretty well timed. And yeah, whatever a guy like Bookvar is saying after that move, that's what he does. That's not what I do, right? Look, what I'm trying to understand is, hey, what happens next? What happens next on the core components of CPI? Are they going to stick? And then on the labor market, which is another question I had for you, it's like, now that we eliminate 21 states taking people off the dole, isn't that going to provide for a potential upside in non-farm payrolls, which has been downside surprises the last 2 months, which is tamped down interest rates?
Well, okay, let's tackle the rental part first. I'm not getting a sense when I'm looking at vacancy rates, I'm looking at absorption, and I'm looking at multiple unit construction. Don't got a big rental price story for you. Maybe you and I are looking at two different metrics that drive rents. We'll see. I think that by September, October, we're going to be printing zeros or 0.1s on the CPI and the core CPI. So I think that we're going to see some significant, and look, a lot of that is going to come from what you're seeing already on the commodity side and the pickup in the US dollar. There's going to be lags there on the goods producing side. You're already starting to see outside of energy, the commodity side is rolling over. And the financial speculation behind that inflation is rolling over. And the dollar is no longer making new lows. In fact, the DXY just popped above the 200-day moving average. That's going to have an impact on import inflation, which has been accelerating over the course of the past several months. So there's a confluence of factors that are going to drive inflation down once we get past the summer months. And then, of course, that's just basically a bottom-up view. The top-down view is exactly what you said. We're going to get employment coming back. But will these people be making more money? Because aggregate demand is not determined by jobs, it's determined by income. Mm-hmm. And the reason why these people have been coming back into the workforce is because they're getting paid more by not going back than by going back. But that ends in early September. So I know that once again, Jay Powell made a big point about the employment's coming back. Good, let the employment come back. At the same time, you're going to have intense fiscal withdrawal. With all deference to that view, we had employment growth in the last 3 months of 2020. Employment came back. But look what happened with the fiscal withdrawal. You have to explain to me, if things are so hunky-dory and the economy was already reopening, the vaccines, Pfizer Monday was November the 9th, everybody was in jubilation mode. Why did Trump have to sign on to a $900 billion fiscal package on December 27th? And I'm not even talking about what Biden did in March. If you think demand is the problem here is that this is no permanent income tax cut. This is not even Obama's infrastructure from 2009. This is not George W. Bush's income tax cuts from 2001. This is not Reagan's tax cuts. This is all basically fiscal stimulus checks that run out quickly. The money gets spent quickly. So all the government's done is create the conditions for a boom-bust economy. And we had the boom, and now we're going to have a bust. We had a bust. People don't realize because they only look at annualized averages. And we went from over 30% growth in the third quarter last year to 4% growth in the fourth quarter. People don't know that from September to December on the monthly GDP numbers, GDP was negative 2.5%. I don't think it's well recognized that up until Trump signed on to that fiscal stimulus that was followed by Biden, the economy was going back into a double dip. I don't think it's well recognized we were going back into a double dip, by the way, with people returning to work, because employment was actually going up significantly. And yes, you're right. Employment is going to go up significantly, and that's a good thing. But these people are going back now. Maybe you're going to say to me, "Oh, well, my model's telling me that the mall operator here and the theme park person and the restaurants, they're all lifting their wages. Don't worry about it." Well, we'll see about that. These people were making a lot more on the dole, and that's why they haven't come back. And they all know their job's going to be there in September, so they're waiting out. There's 9 million job openings right now. Yes, so employment's going to come back. Question: employment comes back. What is the income going to be? And then what's the savings rate going to be? What is going to be spent? And the fiscal withdrawal is going to be absolutely incredible. And I said earlier that, what happened in this cycle that is so abnormal is we had the worst economy since 1946, and yet consumer spending on durable goods, which, by the way, is a $2.5 trillion market, what's getting all the people excited about airlines and theme parks and casinos and restaurants, that's a $500 billion chunk out of GDP. We're all getting excited over a restaurant-led and an airline-led recovery. Have you ever seen that before? That's 4% of GDP.
I'm sure.
Once again, I say, give me a break.
Yeah.
So what happened is that we went on a wild spending spree because we couldn't go out and have fun. So we basically all renovated our home. But you know what? You're not going to fit 2 swimming pools in your backyard, and you're not going to buy another dining room table for your dining room. I don't think it's well understood that from the previous peak before the pandemic, the consumer spending on durables is 30% higher today than it was the previous peak. We did more in 16 months on durable goods expenditure than we did in the previous 6 years combined. We lumped in 6 years of spending on stuff. So people talk about, the inflationary demand impact from all the reopening and flying, and look at the airlines are raising their prices. People haven't factored in about the pent down demand, I have not seen one analyst or economist or strategist, except for me, talking about, and here I will just be reporting the data. I will not be analyzing it. I'll report last week's University of Michigan Consumer Sentiment Survey for June, which showed that home buying intentions, now this is only a 50-year-old survey, okay? That home buying and auto buying intentions are down to the lowest levels since 1982. Now people will say, there's material shortages and there's labor shortages. Really down to 1980, it's because we are maxed out. I had my own chart in my own slide package that shows U.S. household durable goods assets per household. And it looks like a dot-com stock from 1999. You draw the normalized trend line through household spending on big ticket merchandise, $2.5 trillion. Draw that trend line, and the reversion to that trend line offsets the increase we're going to be getting in the services side, airlines, restaurants, theme parks, what have you. People haven't factored that. I don't think the Fed's factored that in. They actually nudged up their GDP forecast for the year. I'm not doing that. I think that people are going to be surprised at the GDP downgrades we're going to be getting. They're not, and maybe just the Treasury market is braced for that. I don't know if anything else is, but we're going to have a significant slowing in aggregate demand, just as the supply comes back, and that's going to be when you're taking a look at top-down inflation. It's only 2 curves. It's just 2 curves. It's aggregate demand, aggregate supply. And I'm going to tell you, I think the dislocation is going to run in the other direction through a good part of the second half of the year.
I definitely don't think it's just 2 curves. I mean, it definitely would include everything that you just said and say that if that continues to impact the currency, don't forget that the currency is what these commodities and inflation, broadly gets priced in. So if you think about this, and this is, again, a long-standing back-tested history. If you print money to infinity and beyond, and in this case, you're right. I mean, it's every other time. It's not this president or that president. This one is wildly unique because you're combining the Fed with the Treasury with a mandate to almost control, print, hit the button on jobs. So, if everything that you're saying happens, by the way, they will be cutting rates by 2022, 23, not raising rates. And that that could easily, create stagflation in dollar terms. Guys, show slide 48 just so that everybody has that. long-standing history. We're inverting the deficit against the dollar, of course. So we tried it in the 1970s, didn't work. Bernanke, to your point, back in 2010, 2011, that's, I definitely part of building Hedgeye was making that call on inflation back then, and then we turned back to deflation. But again, it was this whole concept that you get a free lunch. It doesn't pay off in your currency's term in perpetuity. So that's the other vector that I'm wondering about here. Do you think that with everything that you just said, and the most likely reaction to what you said, and to me that would be stagflation, an economy where demand is just not where you're at. We made a call this morning to short Cheesecake Factory, Red Robin, a bunch of shitty restaurant stocks. Yeah, because the peak is in for that stuff. But if it is as weak as you think it is from a demand perspective, and we actually have reported stagflation, why wouldn't the Fed's automatic go-to move with Janet Yellen be to control print money like you've never seen before, and the dollar collapses?
Well, firstly, I don't know what Janet Yellen's got to do with it. I mean, she's the Treasury Secretary. Tell me what Treasury Secretary, maybe outside of Bob Rubin. I mean, can you name me the Treasury Secretaries that George W. Bush had, or the ones that, all the ones that Obama had? I mean, so Janet Yellen once ran the Fed and was a Fed governor. She was chief economist for Obama for a while, so she's Treasury Secretary. So what? And what does that have to do with monetary policy? And Jay Powell's probably going to be on his way out anyways. So,
well, that's worse. I mean, because the next Jay Powell, her name could be Lyle Brainerd, and she worked for Janet Yellen. It
whatever. Whatever. People said the same thing about Janet Yellen. Look, it's just people just talk. It's just narrative.
That's not people talk. MMT. You think MMT is just talk from the Democrats?
Yes, it's talk. MMT is talk. Total talk.
Really?
And yes. Just and talk. MMT's not yeah, it's total. It's just total. It's people need something to talk about. They need a narrative. Yeah, there's no MMT. Okay, if we did outright debt monetization, they would have to actually change the Federal Reserve Act. It's just people just need something to talk about. But most of the time, they don't really know what they're talking about. Janet Yellen was supposed to be this big puffball that came to the Fed.
I'm definitely not the guy that doesn't know what he's talking about. I mean, Janet Yellen and Lyle Brainerd combining the current setup with this political party in power, Lyle Brainerd replacing Powell with her, and your economic outcome is you will see the most amount of money printed in world history. That is not poppycock. That is exactly what she's in the seat to do.
I'm not saying it's poppycock. I'm saying it's your narrative. You can own that narrative. It's not my narrative. Lyle Brainerd is not so much. She's not. She's actually. Look, there's no doubt that the Fed governors, these are appointees. They're not. I've never really met. I mean, I've been in this business 35 years. The people in the Fed are not crazy. Okay, with some radical political agenda, and Lyle Brainerd happens to be a brilliant economist. What I'm trying to say is that people said the same thing about Janet Yellen. Janet Yellen, the puffball Treasury Secretary that you're talking about, see people saying the same thing when she joined the Fed, and she actually was the first Fed chairperson to raise interest rates in December 2015. She's a Democrat. She was the one that raised rates. The one thing that Bernanke, a Republican, never did. So it's just it's just basically talk.
I just want to get this right. Like, if your economic outlook is right, fully loaded with all the issues, 3D risk, demographics, fully loaded, that this turns into a certified shit show, economically and from a market perspective. You're saying that this Federal Reserve is not going to try to bail. This is not going to be the next bailout from the Federal Reserve. They're just going to stand by.
No, I think that actually they'll probably be forced to do more QE because that's all they have left in the arsenal. Unless we can do something, can we do something on fiscal policy? Beyond there's a danger in doing these short-term fiscal stimulus checks.
Yeah,
and it's because it creates a boom-bust condition in the economy. I'm hoping for an infrastructure package that's big, that has tremendous, when people were comparing Biden to Eisenhower, I was sort of hoping that maybe that could be true. But we're seeing that, look, there's factions of the Democrats, the Republicans, or nobody can agree on how this thing is going to happen, what it'll get spent on, how it'll get financed. And I'm not going to say that I have all the answers, but I will say that we do know that we know what the Fed's reaction function is. We know the Fed's reaction function, and they will probably expand QE. They might even expand their repertoire. They've already gone further than anybody ever would have thought. But when you get to the zero bound, and they're not the only central bank in the world, every central bank has done pretty well the same thing. They're not the only ones. So it's not just about the Fed. It's what you do with the zero bound. Look, I was writing about this in 2019. I wrote repeatedly about what happens if we go into recession. Of course, nobody thought we'd go into recession. And of course, nobody thought we'd ever have a health crisis that would be the exogenous shock. But recessions happen because they're part of the business cycle. And I was always saying, what will the Fed do? And I went through the Bernanke playbook from his famous speech he gave in November of 2002 on the famous, that's what he became, got the moniker Helicopter Ben. And so the point I'm making is that I don't believe the Fed's going to be tapering, because I have a different forecast than they do and the consensus, and I'm being true and blue to my own forecast. They'll probably be forced to do more. But in the context of a deflationary output gap, you said before, look, I have a bottom-up framework for inflation. I have a top-down framework for inflation. The top-down is all about aggregate demand, aggregate supply. It is all about estimating the output gap, and people laugh about the output gap. But if you don't have a version of the output gap, which is only measuring the excess demand or excess supply in the economy, how can you forecast inflation? I said you do need two curves of anything. You need supply and demand to forecast a price. That's basic economics 101. You need two curves. I'm looking at a U6 unemployment rate over 10%, a cap U rate in industry of 75%. They are telling me that we have an output gap still of roughly 1% in a quarter where GDP is 9%, and this is the peak quarter cycle for GDP. And so I think that is going to continue to exert downward pressure, notwithstanding the gyrations. I'm looking at the trend line. The output gap is telling me we are still locked into a deflationary environment. And I know people laugh when I say that, but all of a sudden it's not funny anymore. When lumber's down more than 40% from its peak, and copper's peeling off, and most of the ag complex is peeling off. Oil has got its own set of particular global supply and demand dynamics right now. But I just tend to find that people extrapolate. I think that if you had the view that we're going to monetize the debts entirely, we're going to go to MMT, we're going to get big inflation. If the Fed's going to say we're going to be so risky, we're going to relinquish control of the monetary base, good chance that we're going to get we could get big inflation. But I don't know why people want to forecast that. I don't know why anybody thinks that any Democrat, if the Democrats are so feeling for low income households, inflation's a killer. And inflation is a tax on the poor and a tax on the elderly. And even Jimmy Carter knew that, which is why he replaced William Miller with Paul Volcker in 1979. So I don't believe that inflation. I don't believe we tried to inflate our way out of this debt situation. I think what we have to do is create the conditions to promote two things. Yes, labor force participation. Maybe we have to be more aggressive in immigration. I don't know, maybe we got to pay people to have kids like they're doing in China with the 3-child policy, and productivity. The infrastructure plan, if done right, could be a game changer for productivity. I'd be all for it. And really what we have to do, we're talking about trying to redress the debt income ratio. Let's concentrate on the denominator, which is national income. And there's two components. There's the labor force, but the population is aging. That's a dynamic that's tough to reverse. Productivity, though. That to me is the real key, and that's really what's been missing. And that was missing in the last cycle. The last cycle again was a phony cycle, where companies issued debt to buy back their stock. We didn't go through any capital deepening. Capital investment was weak. It was really, when you think about it, everything was weak in the last cycle. Everything was weak. Huge stimulus, massive financial asset inflation. But I continue to come back to the people who have the big inflation view. Beyond the pandemic and the response to the pandemic, and the fact that we have employment 5% lower now than it was before the pandemic, what's the inflation dynamic here. I find it fascinating that there's people that say they have the two themes, the Roaring Twenties and the 1970s. I find people, it's really a classic case of cognitive dissonance. I'm hearing the same people talk about the Roaring Twenties, and they talk about the 1970s. But yet the Roaring Twenties had mild deflation. It had mild deflation coming out of the pandemic. You know why? You know why? Because of electricity. Because there was something dynamic that created the conditions for accelerating productivity growth, and productivity is an inflation killer. That's really what we have to do. Could the green revolution, could that be something that is transformational? 5G technology. To me, that's really the key is what can we do to improve productivity? And I'd say that maybe one of the anti-inflationary developments coming out of the pandemic, because of course there's been this rupture between supply and demand that's created this condition for inflation near term, but productivity has been picking up. And a lot of people and a lot of companies learned how to use technology because they had no choice. And if you're any sort of old economy business, you needed to get an online thumbprint in the pandemic to stay alive. So I was actually interested to see that in the worst year for the economy since 1946, GDP was down 3.5%. That business spending on automation actually increased in real terms by over 6%. And now all of a sudden, productivity is running at 4%. Now, I don't know. I said before that the data have become very noisy. Maybe there's noise in the productivity data, but productivity's been picking up. Mm-hmm. So let's keep an eye on that, because from a supply side standpoint, that's a tough one to say. I'm going to have an inflation call if productivity's starting to pick up. And that's, again, nobody talks about that. You can get 4% wage growth and 4% productivity growth, and your labor costs are running at zero. There's nothing inflationary about that. Mm-hmm. So I just tend to find, people talk about money supply. They don't talk about velocity. They don't talk about why is it that bank credit is contracting. But you can't talk about inflation just from a purely Fisherian identity, the quantity theory of money. You can't talk about inflation through the money supply without talking about money velocity. You can't talk about wages. You can't talk about nominal wages as inflationary without talking about productivity. Nobody talks about productivity. So I tend to find a lot of the analysis, I'm talking about the big picture analysis on inflation, from the people I read and see, is really incomplete. Everybody is into partial equilibrium analysis. Nobody is running general equilibrium analysis, I think, except for me. But then again, I don't know if I read my own stuff, but I certainly write it.
That's awesome. Yeah, I don't watch Old Wall TV or read the Old Wall Journal. I have no idea what they're saying, nor do I care. I just want to get the next move right. So if you don't mind, I'm going to just get some of these questions in the queue. And one of the first questions, because they get voted up, one really actually has to do with the velocity of money. And I think part of that is that if you look back, part of that's just an empirical fact. Just because you're printing money doesn't mean that you have the velocity of money. If you go back to the decade that was 2010 to 2020, you really had very tepid M4 growth in terms of measuring the rate of change of that. And people got it wrong. They thought there was going to be inflation because there's a lot of printed money, and there wasn't. But now, looking back at the last year, M4 has grown almost 30%. So there is a lot of velocity. And really, I think the first question on that has to do. They're asking. Mike from New York is actually asking about M2. We don't need to geek out about M2 versus M4, but during the Great Financial Crisis, the velocity of money dropped dramatically and never really recovered. It has dropped again during the pandemic, which is not true. Well, I'm saying that that part of his question is not true. Do you see catalysts for money velocity to pick up this time, which it already has? I think so. And he's saying thanks, but I think you're saying that the velocity of money, which picked up because we did a bunch of stuff, is about to slow again, are you not?
Well, I think money velocity, the rate of change is not as negative, but money velocity is not going up. And it would make absolutely no sense for it to go up. It only go up if you start believing that we're going to start seeing a credit creation process. I said before that the household sector has been deleveraging. And so if the household sector stops deleveraging, velocity will go back up. But I'm not seeing any of it. We just got the first quarter Fed flow of funds numbers. The flow of the household flow of funds savings rate is over 16%. First quarter, which included the gargantuan stimulus and the massive retail sales number. But of course, because I said before, it's 75% of the proceeds. So it's just like, so you're talking about the government. The government is basically dissaving, giving this money to the proletariat, but they're only spending 25% of it. Mm-hmm. And you can't forecast inflation, and you can't forecast interest rates just based on fiscal policy, because you're talking about how you want to be right on interest rates and you're trading the market. Well, if I told you that Uncle Sam is going to be running surpluses in 1999 into 2000, you'd be saying, well, I got to be bullish on treasuries. But it was a horrible bear market in treasuries because the savings rate in the private sector was plummeting as the government was building up their surpluses. If you remember, Greenspan was lamenting, how are we going to spend these surpluses? You have to take a look at where is desired savings benchmarked against investment spending. Desired savings, it's called the IS curve. It's the first thing you learn in economics. Investment and savings. And interest rates will equilibrate those two curves. So we're actually in a savings glut. All the guy said before, all the government has done, can you imagine where the output gap would be without the fiscal stimulus? I said the level of GDP would be 6% lower than it is today at a time when the U6 unemployment rate is over 10%. Imagine where that U6 would be. So all they've done is they've been fixing a leaky boat with ridiculous short-term stimulus, which has no multiplier impact. Yeah, so guys, how are you going to forecast rising money velocity at a time when the households are deleveraging? And it's been an ongoing process. That's not temporary. That's a secular disinflationary trend. I said before, if you're taking a look at periods of time, the savings rate averaged 2 percentage points more in the last cycle than in the pre-Great Financial Crisis cycle. You don't think for a 70% share of the economy called the consumer, that's not significant? People say, why? Why didn't inflation go up from 2009 to 2000? Well, it went up and it went down and went up and went down, and we finished off at basically 2% with a 3.5% unemployment rate. Yeah, so the problem is velocity. If you're going to say to me, hey, Rosenberg, here's my model on credit, and we're going into a credit boom, I'll say, okay, velocity is going to start to go up. That's not my model, by the way, and it's not my forecast. But we're in a business, you and I, where your assumptions drive your forecast.
Yep.
If your assumption is we're going to a new credit creation cycle in the private sector, the corporate sector, I go through the Fed flow of funds that came out last Thursday. I spent 2 days going through that report. That is probably the most important report anybody should focus on, the quarterly Fed flows of funds. It tells you everything you have to know. And what you have to know is that the savings built up in the private sector is overwhelming the de-savings from the deficits in the public sector, which is why interest rates aren't backing up the way people thought. Now, admittedly, you were right. Rates backed up. Inflation, it was actually more real rates than inflation. Okay, now we had the inflation from commodities. Okay, we had the inflation, but I mean, really, but oil had bottomed months before Treasury yields started to back up. The back when Treasury yields really happened towards the end of last year.
Yep.
And it was really after Pfizer Monday, which was a massive game changer. When I look back, that was a day to say, bull. I am bullish on everything risk. Pfizer Monday, game changer, U.S. election, the Georgia runoffs, the 2 rounds of massive stimulus, but then it's over. So I don't even think, if you're just asking me, how we got to 174 on the 10-year note on a closing basis, admittedly. Inflation was the sideshow. It was really real rates related to higher risk appetite and the fact that we're going to have gargantuan economic growth.
Well, right? you had more than that. I mean, you had slide 42, guys. David knows this, but I mean, you had a massive acceleration into. I mean, the market front ran the two things that are going to drive interest rates higher faster, which was inflation went up. It went from 0 to 5, and non-farm payrolls ripped to 770 after being negative only back in December. Right? Like that's a big rate of change move. And again, you're not talking to the guy who's Johnny come lately here. I made this call on November the 1st, so. It was a great.
Well, I hope that on March 31st you switched and you went bullish on bonds on March 31st, because All of a sudden, when you're taking a look at it, the inflation's already rolling over. The commodities are rolling over. They're rolling over. The dollar is broken above its 200-day moving average.
Yeah, but
At a time when the narrative is peaking. Come on, 2 weeks ago you got to the front page of Barron's, the capital I, the inflation. Did you see the Barron's Roundtable? The Barron's Roundtable.
That's not analysis, as you said. I'm an analyst. I don't look at that. That's
well, I'm
Barron's
just saying, but
Barron's.
it's the inflation trade is the most crowded trade. Well, what I am saying though,
it's actually not, Dave. If you look at
what I am saying,
I look at
look,
data. CFTC
what
futures and options positioning. The most crowded trade in the market is your position. The most crowded position in the market is actually the street is net long 10-year notes. That's greater than 2 standard deviations relative to itself. It's the biggest position net long 10-year bonds in 3 years, David. That's the position of the market. That what's on the cover of Barron's is for monkeys. And so is the 200-day. I mean, I'm assuming you've backtested the 200-day. I mean, when the dollar got above the 200-day in March, people are look at the big breakout. I mean, if you invested on that, that's just that doesn't make sense. I mean, people don't. We're not using 200-day moving averages in the cover of Barron's. I mean, the positioning of the market is net long the concept of transitory inflation, and that the jobs market's going to remain benign. And you actually, interestingly, you agree with me that the jobs market's going to pick up in the next couple of months.
There's no doubt the speculators have been net long for several months now. And that you're right, that could be, from a trading perspective, that could be a crowded trade, but somebody is seeing something, okay?
Yeah, I think it's labor rolling over.
Past 2 days, look, the reality is this. I have 3,000 clients, okay? I'm only getting questions about inflation. Only questions about, I'm telling you, I am only getting questions about inflation. I can't tell you the number of institutions that have asked me to come on their call because I'm and I'll tell you, the biggest hedge funds in the world have asked me to come on their internal call because I'm so diametrically opposed to how they're positioned. Okay, so I'll just say that with all deference to the CFTC data in this particular respect, the sentiment on inflation is off the charts. Off the charts. I have not done more debating. I think the last time I did debating on something like this was when people thought I was crazy on the housing call, back in 2006 when I was at Merrill. So I'll just tell you that, yeah, there's a CFTC data. I guess there's the fast money guys are maybe buying into my view, and maybe if they close their positions, we'll get a hiccup. We were supposed to get the hiccup. Jay Powell was supposed to be the guy that gave us the hiccup on rates because apparently he turned hawkish yesterday. Then why is the long bond yield melting?
Because there's a big place called China.
Why yesterday? Yesterday, when the narratives were all.
Did you see
yesterday,
the Chinese were selling commodities, David? That's a pretty big deal.
The narrative. Oh yeah, the narrative all yesterday was how the Fed is finally acquiescing to inflation and growth. So tell me that what did CRB metals? Forget the bond market then. Why would CRB metals sell off yesterday?
Because the dollar went up.
Why did the inflation? So. Okay.
Did you see what happened on the front end of the curve?
The industrials went down. The transports. Oh, so the dollar. So the dollar. So actually, what you're saying is that financial conditions tightened, and therefore because
I didn't say
you
that.
Understand. You even understand. Powell was so positive, and that he tightened financial conditions to a point where all the inflation indicators went down yesterday. All right.
It's actually not. That's not what happened. What happened was that they took up their inflation forecast closer to where inflation has been reported. The short end of the curve had its first and only one-day move to the upside. The 2-year note went from 15 basis points to 22, and the currency market absolutely reacted to that because the relative trade on that, relative to anyone else who said anything incrementally in monetary policy, was the other side of the trade. I mean, commodities go down when the dollar goes up. That's what happened. That was like a 3-day trade.
Okay.
It's not?
No, what I'm saying is that people were the aha moment that, well, firstly, the Fed didn't change its long-term inflation forecast. They marked to market this year's.
No, but the bond market believed it, David. You can't on one end just look at the long end of the curve and not. Do you acknowledge what just happened on the short end of the curve? The bond market believes that the Fed.
The short end. So what? All the information, my good friend, is at the long end of the curve. The front end of the curve. The front end of the curve is only reflecting monetary policy.
Exactly.
That's it.
And that's what moves commodities.
The long end of the curve is reflecting a whole confluence of factors from inflation. In the most the most important inflation expectation determinant and the most important fiscal policy determinant is at the long end of the curve. The long end of the
100%.
curve is the most complex part of the curve to forecast. The front end is easy peasy. It's about monetary
100%.
policy.
And nobody's
So
had a better forecasting track record on the long end.
The Fed says we're moving our dots up and the 2-year note moves. Oh, it doesn't take a rocket scientist to draw those dots.
Well, that's
the long
why
end of the curve. The long end of the curve is telling you something. The long end of the curve is telling you something about where inflation is going to be going, and where the economy is going to be going. That was the fascinating. Right. The fascinating aspect of it since the meeting is not that long-term rates went up by less than short-term rates. It's that rates at the front end went up.
So the
rates at the long
commodities went down because demand changed
overnight. Rates at the long end have come down, and actually, the factors precipitating that has been inflation expectations,
right? Which
all of a sudden are reversing course. So you have this big inflation view, but your own markets are telling you that inflation, your own markets. Okay, the flattening of the curve.
I think if you listen to some of the things I'm saying, you'd understand my view. I don't have a big inflation view. I have let's get markets right view. I've had interest rates right at every big turn for a long time. It's not like you're talking to some idiot. I don't think you think I am, but even if you did, I wouldn't care. The fact of the matter is that the commodities market just got clocked because the Chinese said they're selling commodities, and the Fed just moved. The only thing they can move, which to your point, is not the long end, it's the front end. And when they move the front end, the currency market moves, and that's the correlation trade on commodities. Commodities 4 days ago hit a new cycle high, David. It's not like,
No. Commodities, only because oil did. The base metals peaked well over a month ago.
The CRB commodities index.
The ag complex peaked well over a month ago. Lumber was in a steep downtrend. And lumber, by the way, has got nothing to do with what the Chinese are doing. Lumber was in its own dynamic.
Lumber has nothing to do with the CPI calculation, by the way.
Lumber was already down 30%.
Any analyst knows lumber has nothing to do with getting headline CPI right? It's just a thing to talk about. Like you said, people talk about things. Right. But the fact of the matter is that oil is the heaviest weight in the CRB index, and it's the heaviest weight on any inflation nowcast. Like if you're not modeling it that way, I don't think that that's you. But I mean, you'd need to be quite a macro tourist not to understand energy's component, in terms of calculating CPI or shelter for that matter. You take both of those and you get those two things right, you're going to be a very good analyst for the rest of your career on Wall Street.
I've never seen anybody accurately forecast oil prices.
You don't have to. You nowcast them.
Okay. Well, I don't know what the nowcast was showing back in August of 2008. So the mantra is that inflation is the highest, 5%. You could say we've gone from 0 to 5. It's not the first time that happened. I've shown in the last cycle we had multiple spasms in inflation. A lot of it, if you're looking at headline and not core, is principally caused by food and energy. We got to 5.4%. In fact, 3 months in a row, June, July, August of 2008, inflation's over 5%. I'm Merrill Lynch Chief Economist. I am in internal debates all the time about inflation. And everybody thought, and if you remember back in the summer of 2008, the Fed switched to a tightening bias. Trichet at the ECB raised interest rates. Nobody even knew we were in a recession. Okay, you had people out there on Wall Street saying we were in a soft landing. They thought that Bear Stearns was in the rearview mirror. Nobody was thinking about AIG, Fannie and Freddie, or Merrill or Lehman. And this was all in the summer of 2008. So when I hear, inflation's gone up, has done a 5 handle, and of course, oil was $140 a barrel back then.
Yeah.
And the mantras were that we're going to $200. Well, I don't remember that going to $200, but what I remember is that a year later, inflation went from 5.4 to negative 1.5. Mm-hmm. So extrapolating today's, and people were talking about the same thing, a new era in commodities that were, and actually people didn't even know the recession started in January of 2008. But you see, the NBER hadn't announced it yet. Everybody thought we were in a soft landing. Bear Stearns was a contained part of the financial situation that JP Morgan with the Fed helped resolve, and it was all easy peasy. It's all over. The ECB raised rates in the summer of 2008. The Fed went to a tightening bias under Bernanke. Oops. So people just hyperventilate. They extrapolate the latest experience into the future, and that's where they get it wrong. Mm-hmm. So I don't know where oil is going to be a year from now. I understand the conditions as to why it's rebounded the way that it has. I don't know. Did anybody ever predict what was going to happen when oil prices fell through the floor? When was it? In 2014, when OPEC opened up the trap door and oil went collapsing? Who knows? It's really a very controlled. I mean, OPEC plus. So who knows? And who knows what's going to happen at the next OPEC meetings? And who knows if travel demand globally will continue to accelerate? What happens with the variants? Right now, the U.S. is reopened. Most other parts of the world haven't come close to what the U.S. has accomplished. That has an impact on foreign travel. Who knows where oil is going to be going? I don't have conviction in the oil price forecast. That much I do know. But I do know this much. The last time inflation was at this level, the narrative on inflation sounded a lot like it does right now. Mm-hmm. And nobody was predicting a year later we have a minus in front of the CPI prints. That happened to span of 12 months. We had over a 600 basis point swing in inflation in a 12-month time period.
Mm-hmm. That's why calling it 12 months ago should have been something that you nailed, right?
Well, I say that I didn't hyperventilate over the deflation. I've been a secular bond bull. I should have turned more bearish, but not for the reasons you're suggesting. I think looking back, Pfizer Monday, I say Pfizer Monday and the Georgia runoffs were two really critical dates from taking on a more risk-on view. But then again, and then the view changes, right? All of a sudden, so you go value to growth, steeper yield curve, bullish on financials. But all of a sudden, the curve is not steepening anymore. A lot of this growth is priced in. We're not having the economy go from close to reopen. That trade is largely done. And the fiscal stimulus is behind us right now. But you're right. Look, from your perspective, because you're an investor and a trader, I'm more of a coach. But you're quite right. But I don't have any regrets about the inflation that's caused by a commodity spasm, and I don't believe in the inflation story. The real rate story to me, and I would have caught a lot more of the bond yield sell-off by understanding that there was a different risk dynamic coming out of Pfizer Monday and the Georgia runoffs. Bigger impact on growth has an impact on real rates. I wouldn't say it doesn't have a secondary impact on inflation expectations, but if you had the real interest rate story right, you would have got most of the bond market story right. So lesson learned, for the next cycle. But what we're saying right now is basically, look, when we were back below 1% on the 10-year note, you had a lot of bad macro news priced in. And now you have nothing but euphoria priced in. I looked at Jay Powell yesterday and I'm thinking, boy, this is actually a Goldilocks scenario. But if it seems like a Goldilocks scenario, there is no such thing as a Goldilocks scenario. So I'm not the least bit surprised. What I'm most proud of is that I didn't drink the Kool-Aid, okay? That I didn't say at 174 in the 10-year note, I did not scream uncle and say, oh, my analysis is completely wrong. I'm completely wrong. Yes, we're going to 2.5%, 3%. Look at all the people still saying that we're going to 2% plus in the 10-year note. And now all of a sudden, we're going the other way. So I stuck to my guns. I'll tell you the truth. I wish back in 05 and 06, I was more bullish on equities. I was pounding my fist on the table when I was at Merrill on the housing bubble. Okay. Pounding my fist. And I was wrong for 2 years. But then proven to be spectacularly right. And that's what people remember, by the way. So look, I'm not a market timer. People don't read my stuff and pay for my research for a market timer. I don't claim to be a market timer. I'm a big picture strategist. And I consider my role to be to catch the changes in the trend line. And I'll leave it to others to identify the gyrations around the trend line. But when the trend line changes, I will be the first to let you know.
Well, that's a good summary. I mean, at the end of the day, you have your process and you have your conclusion, and you outlined it with conviction. I think everybody heard that, and I appreciated that. That's at least at least we can still have like a debate. If it was Leafs against Habs, maybe it would have gotten a little bit more rough around the edges. But I appreciate that, man. That's like, again, not many people have a process, so they don't stick to one. They just whip around, like you said, headline to headline, reading the cover of Barron's and whatever else. That's definitely not what we do here. But I appreciate it.
Yeah, well, and the same thing is, look, and you appropriately called me out, and look, I've been doing this 35 years, and so if you don't have a thick skin in the forecasting business, go do something else. But you can't hide. Look, I don't hide from my mistakes. I try and learn from them. Yeah. So the same point. I wish I would have caught this bond sell-off. I'm thankful that I stuck to my guns for this last, say, 25 basis points. We'll see where it goes from here. But I don't let short-term influences determine my forecast. It's really, I got to see the trend line change. And there's been times in the past when that has happened. The trend line changes. That's a really big call, and
Yeah.
everything else to me is shorter term in nature. And that's, tell you the truth, I mean, that's not easy to do. If I could do that, I'd be you. I mean, being an investor and a money manager takes a certain amount of temperament and discipline that I'd be the first to say that I don't have that skill set and I don't have that temperament. But it's like I don't, I consider myself not, I'm not a goalie in hockey, but I'm a goalie coach. And I think there's still a role for a goalie coach, even though I might not be able to stop the puck for you.
Yeah, especially if you're Carey Price's goalie coach. But again, like you and I have that in common too. We're both Canadian. We both do our own work and we stick to our guns, and that's the way it should be. I mean, being driven by what other people think and what the market does on any given day. I mean, that's crazy. So thanks for that, and good luck to your. Good luck. I can't believe I'm going to say good luck to the Habs. I'm being too nice right now, but good luck to the Habs. I'm not a Habs fan, but good luck. He's David Rosenberg. He's the one and only. I thought that was great. Thanks for joining us.